emergencies. And so we know that after the Great Recession, there was $7 trillion or something thrown into the economy, and that did bring things back, but it was a slow process. And so just last fall, things were starting to slow down. Now, we also had an election coming, right? And I think our president didn't want to see a slowing economy while he's campaigning for re-election. So we did start to see this repo, this money created out of nowhere to come in, give into the banking system. So something was going on. No one was talking about it. I was trying to get information, but it was really hard to get. So that was already happening. And that's why I said, you got to be cautious. And I've been saying that for a few years now, as I started to see more and more people get into real estate investments and get into stocks, and not paying attention to fundamentals. So we're going to talk about what those fundamentals are. But what we were seeing at the time, I wish you could see the slide. I don't know if you want to see the slide. It's a depressing one.
Yeah, Kathy, somebody is sharing your slides here. Thanks to them for being able to do that. I don't know why I'm not able to. But just call out which slide you're on, and I'm sure they'll scroll through.
I can see it now. Yay. Okay. So let's go back to slide 5. Okay. And a little bit before this.
I don't see numbers on them, so you'll have to
just
read the title of the slide.
Yeah, back a little bit. And yeah, so you can see here's a slide of our economy was already slowing down. You see that Q1 of 19 and Q2, Q3. So there was a whole lot of talk about our GDP there. We were just booming as an economy, but you can see there that wasn't really the reality. So it was right around Q4 that we started to see the repo and money going into the economy. But at the same, so something was already going on. There were underlying issues, massive national debt. We had a $1 trillion per year deficit. I mean, that's not a booming economy, but that's what we were seeing in the headlines. So whenever it comes to investing, you've got to just read between the lines. Don't believe what you're hearing, and look at the real data. And this was real data, like, it's not growing like people might be thinking. So what is going on? So we can go to the next slide. And like I said, I also said, we've got this low unemployment, but typically after recessions, it reverses, right? We start to see job losses, and you can see in past recessions, those are sort of the gray lines you see there. This is a slide from the Federal Reserve. This is initial jobless claims, and the gray lines are recessions, and you can see where there's low unemployment and then it goes up. Well, if you look to the right, it's not funny. I don't know why I laughed. It's just shocking that how that line went up to like something we've never seen. It's unprecedented. 3.3 million job losses in a week. So it kind of looks like that black swan, doesn't it? It's, the long body and then the neck goes straight up. So this is, again, unprecedented. Never in history have we had this many job losses in 1 week. And it's just this week. We are going to see more. So we're in a very unusual time. Some people are saying we're going to, get up to 5 million job losses. Some say more. So that's what we don't know, and it all depends on how this all plays out, right? We hear some people saying the only way to get through this is if we contain, people stay home, don't overwhelm the system and so forth. But we're hearing a lot of different messages, right? That it's not a big deal. It's the cold, it's the flu. Let's get back to business. And, so that what could turn this around much more quickly is if we follow the rules of pandemics. And that is, you don't spread it. So we don't know what the future will hold. If we don't contain it, it could be a much longer, deeper recession. If we do manage to contain it and find a cure, or just find a way to get the tests and get the things we need to for what, the pandemics, it's nothing new, right? There are people in universities who teach how to prepare for a pandemic. There's movies out on there's a movie called Pandemic. There's a movie called Contagion. There's a TED Talk on it. So it's not like this should be any kind of surprise, really. We know what happens when pandemics happen, and we know how to stop them. And one way is wearing masks. One way is not going out in crowded places. Doesn't mean you can't keep working, but you just have to behave differently. And we didn't treat it that way. Many governments did not treat it that way, but everyone keeps comparing to China, who did treat it properly and is recovering and has led the way on how to deal with this, but we're not still following them. So the reason I say this is we can get through this faster or slower. The way things are going, it could be slower, and that would not be great. That would lead to more job losses in the future, in my opinion. So we have to really pay attention to how things go. And what's interesting, and this is going to sound political, and I just, it's my opinion, so take it or leave it. However you want to deal with it is up to you. But we heard the president say we're going to get back to business, but he doesn't really have that control. And I think that's what is surprising to him, because he's not the one who said stay at home. It was the cities and the governors and the mayors and the individuals and companies saying stay home. I know for us, we told our employees we canceled our events before anybody told us to do that. And there's reasons for that. There's liability. I didn't want to send anybody to work or to events who I could be responsible for something terrible happening. So I think a lot of other businesses felt that way too. So they took action, and so did cities. Didn't want that kind of responsibility. So did mayors and governors. So, I think what we're learning from this is that power's kind of coming back to the people, I guess you could say. It's kind of up to us. It's kind of up to us how this goes and how small companies want to deal with it, how quickly we can continue business, but just not business as usual, just a little different. I love seeing how restaurants will say, you know what, we're going to do this, or we're going to do that. We're going to find a way to stay in business. People still need to eat. So there are jobs being created, and the quicker, now, you all are in the tech industry, and you're the forefront of change, in my opinion. So it's like the quicker we can jump on to these changes, create more jobs, the better, but jobs that still allow us to keep the spread down. So anyway, that's my opinion. This can go two ways. It can be a very long, deep, dark recession, or it can be fairly quick if we just do the right things that have been proven to work in pandemic situations. So let's go to the next slide. And again, here's the effect. They're just kind of shocking slides to look at, but that's how quickly stocks can move from a headline. Let's go to the next slide. I know that's not a shock to anybody here. But what about real estate? So here's the most recent slide I could get from Fred. And we don't see a slide yet, right? That's what I meant. It's a slow-moving vehicle. Now, we do know the last downturn was pretty deep and heavy in real estate, and real estate caused it. It wasn't a black swan event that time. It was just bad lending, right? Just really, really bad, stupid lending. And that caused a recession. You look at the slide and go, and it's interesting. It recovered. It's above where it was before, and certainly over the years it has gone up. So again, just an interesting slide to see that it takes longer in real estate. And like I said, it wasn't real estate that caused it this time, so we don't really know how it will be affected by this. I have some ideas about it, and I'll share that in a minute. But again, like was said earlier, anyone who pretends they know what's going to happen is just making it up, because we really don't know. We don't know how we're going to respond. We don't know. We hope we do the right thing, but so far we're not really seeing much in real estate. Like I said, my deal is still in escrow, and they're excited to close. And so I guess this is a good time for me to say why. Why are these people excited to buy this house I'm selling? Well, my guess is they want a really safe place to shelter, right? The term right now is shelter in place, stay home. And that kind of elevates the value of a home. That's what we're seeing. We at Real Wealth Network, we have people all over the country who find homes, discounted properties, they renovate them, they get a tenant, and they sell that sort of already rented property to people like us in California, to people in our network. And we are doing daily webinars at Real Wealth with these different property managers across the country saying, tell me real time what's going on. We need to know. We have investors buying these properties or owning and want to know what's going to happen to their investment. So we want the truth, what's going on. And obviously it's very early, so we don't know for sure. But each one of the property managers has contacted their tenants. And it's so far a very small percentage who are not paying. And that's because, guess what? Nobody wants to end up on the street right now. You know, it's like I said, it's a high priority item to have a home and have a place where you can shelter in place. And so that was surprising to me too. Now, May could be another thing. I don't know. But if people are getting a bailout from the government, I know we just did a webinar with our Detroit guys yesterday, and the big three, I know at least Ford is still paying their employees, even those who can't work. They're paying them like 88% of their salary. And, you know, you're not going to go spend that on a new barbecue. You're going to pay your rent because you don't want to get kicked out and booted on the street right now. So that's basically what we're seeing. Again, that can change, but it's just been kind of interesting. Let's go to the next slide. This is just an interesting slide I show every time when I do my forecasts every year. And it is the money supply. And this is the way our economy has changed. And this is what we have to be paying attention to versus other metrics that economists would look at in the past. Because you can see when you look at the past, money wasn't printed out of thin air and thrown into the economy. That changed in 1971, I believe it is, when Nixon took us off the gold standard. And the Federal Reserve was given the power to print money. The U.S. government can't print money, but the Fed can. And they're not a government entity. They are a conglomeration of the biggest banks. That's what the Federal Reserve is. It's not federal and it has no reserves. It's just the big banks. And they've been given an enormous amount of, I guess, quasi-government responsibility, though they're really the banking system. So it's confusing when people say the Fed. They think they're talking about the government. They're not. But the government works very closely with the Fed because the government wants money. And up until 1971, it was tied to gold, so you couldn't just print unlimited amounts of money. That was not allowed, and our Constitution doesn't allow it. But it does allow us to borrow, and that's kind of a caveat. That's like something maybe was overlooked because nobody thought it could maybe be done in this way. But after the last Great Recession, well, that we know that's when the Federal Reserve went crazy and just like, all right, we got to bail us out. We're just going to print unlimited amounts of money, give it to the banks so they have banking reserves, so they can start lending, because our economy is 70% dependent on us spending money. The government really wants us to do it. That's how, since we haven't been a manufacturing country, we are a buying country. We just have to keep buying stuff to keep it going. And when that stops, it all stops. So that's one of the big things that'll come out of this, I think, is that we'll start manufacturing more here in the U.S. But regardless, this is how we've dealt with past recessions. Well, at least this past one, just creating a $4 trillion, or I think globally it was closer to 10, but trillions of dollars, unprecedented, throw it in the economy, and it worked. It wasn't like mind-blowing how it worked. It was a very slow recovery, but it did work. And that's what drove asset values up. It wasn't so much all the other things that certain people were bragging about. It was simply going to throw a bunch of money into the economy, you're probably going to get a good result because more people will spend. More people can borrow it. More people can buy things. And, a lot of stocks were bought on more margin. A lot of companies bought back their own stock, and that brought up the stock prices. So there's a lot of manipulation there. Well, I don't know if you can see it on this. I found it very interesting. There's a little red line there that says this series will no longer be updated. And that is interesting to me because they don't maybe want us to know what they're about to do. Even though it's out, it's out, that we have the $2 trillion, package that's coming out, but we have what's less talked about is the unlimited QE that is now happening to keep everything afloat. It's to the tune of $4 trillion at this time, but it's unlimited. So basically the Fed is going to print as much money as they need to get us through this black swan event. So if you can see, we were already at the beginning of this at what I had said in January was a very fake economy, because if you have that much fake money rolling around, well, all the lift in asset values was fake too. And that's why we've seen a very separation between the wealthy and between the haves and have-nots, because if you don't own assets, you don't get to ride that. You don't get to ride that roller coaster up. So people who didn't own real estate, people who didn't own stocks, they didn't get to participate in all that, all that fun over the last 10 years of asset values increasing because of all that money. So I think that's what we're in for, is they're going to just go to the tune of double what's already there. You see $4 trillion there. Well, they're going to do at least that much now. And their intent is to raise asset values, to increase stocks and to increase the value of real estate. Because if those two things go down, there aren't going to be any jobs, So they're going to it's like all out, this like throw money, like just throw it out there. And so it is my belief. I can't say that asset values are going to go through the roof because they were already too high. But it's going to the Fed's going to do everything it can to keep it from collapsing. That's kind of more how I think it might play out. Again, no promises, just what I'm hearing. So let's go down one more slide. Do interest rates. You can see here once again unprecedented stimulation. This is stimulus. This is financial stimulus that's never really been done before in this way. And the way you get people to spend money is to borrow it, And so the second way that besides giving people bonuses and, just creating money, giving it to the banks so they can lend and so people can keep buying homes and so forth. See, there's no buyers right now for mortgage-backed securities. Nobody wants to invest in home loans right now, for obvious reasons. Like why there's a secondary market basically that usually buys mortgage-backed securities. But if you know that 5 million people are losing their jobs, you're not going to want to buy loans right now. So that secondary market disappeared. So that's part of what the Fed is doing. They're coming in and buying those since nobody else will. We are now, you and me, because we got to pay for all this, is the secondary market for loans. And that's, again, what they're doing with interest rates. The way you keep interest rates low is you buy bonds. And that's what the Fed is doing. Also buying bonds to keep interest rates low. Hopefully that'll get a bunch of people to, to borrow money and buy homes. So they're just going all out on stimulus, like throwing everything at it. And obviously the president is on board with that to keep asset values up before the election. So next slide. And I hate to say this, I have only 10 minutes, so I'm going to try to go through this. I feel so bad with the way this started, but maybe we can also reschedule. I have an interview. I'm doing it at 1. So do you want to, Daniel, you want me to just kind of race through this and then reschedule another time to go through the rest, or how do you want to? I'll just keep going. Okay, so what we know is different from last time. We have about 25 million more Americans, so our population is growing. Go to the next. We know that these are, very big generations. About Gen Z is a large generation. The Millennials is the largest now, 79 million, and baby boomers are aging. And boy, I'm ready for the silent generation right now, and it's going to be interesting. But what we know is that millennials and Gen Z are very large group, and they have been forming households, living on their own. And what I think we're going to see more of is it's going to be harder, but there is a move right now for people wanting their own place. If you've got young people mixed with old people, that's just not the best thing right now. So more and more household formation may happen, but where and who? Let's go to next slide. Just before all this happened, we were already seeing, like I said, almost 25 million more Americans since the last recession. But we also had way more renters versus homeowners. That little sliver is the homeowners and the rest is renters. So massive demand already before all of this for renting. And that will probably be the case. More demand for renters, even though some people will still buy, but a lot of people aren't able to because of the next slide, which is consumer debt. Lots of debt out there. Probably that's going to increase with the situation, forcing more people to be renters, but also wanting their own space. Next slide. I mean, you should see the people just fleeing New York right now. And they're going to Florida, and Florida's saying, don't bring your germs to here. So now they're on 2-week quarantine. But our Florida guys are just busier than ever. They buy the properties, fix them up, and put renters in them and sell them to our members. And they're getting a lot of calls from New York, but they have to be quarantined for 2 weeks before they come. Again, massive student loan debt. There's a very good chance that will get wiped out through all of this. We'll see how that plays out, but we know that that's another reason why a lot of the young people haven't been able to buy. They've been renting. Let's keep moving. And U.S. home prices, we can just skip that because we don't know where that's headed. It has been higher than in the past. The bottom line is we already were seeing great demand for rentals, huge demand, not enough rentals, mostly in the affordable range because these are young families starting out. And we're going to probably see more demand. Next slide shows that we were already really undersupplied in housing. So new builders, new builds, they just couldn't get up and running in time, and it was very risky. They didn't want to take any risks this time. So the blue slide shows the undersupply of housing, and it was expected to continue to grow, and it was just really a big problem. There's not enough affordable housing, too many people that wanted it. So we're not in the same kind of situation we were in last time. There's been tremendous demand. So even if there is a lot less demand, we're coming from a massive undersupply. So that will be helpful as people let me put it this way. If we did see more people moving in with each other, that would alleviate some of the problems we've been seeing with lack of housing. Mortgage debt, let's kind of go to that one. In this scenario, over the last 10 years, we saw a lot of people buy houses cheap. They got into low interest rates. Rents were going up, but their payments on their homes were much cheaper. Not in California so much, but in a lot of other areas. So this time around, starting before this Black Swan event, there was a lot of home equity. People locked into low payments that they had qualified for. They had a lot, bought cheap, prices have gone up. So it's different dynamics than we had last time. We're definitely it's not a housing problem this time, but it could affect housing, and that's what we have to pay attention to. So the question would be, where are people going to be going? Where are they going to be renting? Who's going to have jobs that could be renting? If you were looking to invest in real estate, you want to make sure you're in the right place. Now, multifamily had 28 million households. Single family had 16 million households in rent. I think we're going to see a lot more people moving to single family if they can. And maybe, if you've been cooped up in your apartment for a month, and depending on how long this thing goes, you're going to really want a yard. So we are already seeing people kind of moving out of the multi, going into the single family, unless the multifamily has, balconies or some way to get outside. But still, this event could change the way we live for a while. And we think, at least I think, there's going to be more demand for the single family moving forward. And it tends to be people with higher incomes. And already we were kind of coming from a overvalued apartment world. People were just paying ridiculous prices for apartments because there's a big push for it. With the San Francisco East Bay, technically this is a John Burns real estate consulting slide, East Bay being overvalued, Nashville, Miami, San Jose, Sacramento, and just a few markets were not overvalued in apartments. So moving forward, I actually think that in the future, there will be some fallout in the apartment world. And there could be, on the flip side of that is opportunity. So I think in the future, there could be opportunity to buy apartments pretty cheap. Okay, I'll just blow through these slides. Back in 2005, I had Kosaki on my show and on the Real Wealth show. And you go to the next slide, he was saying, you got to get out of expensive markets and get into affordable markets if you want to avoid the recession. So you can see here, he told me he sold everything in California in 2004, 2005, mostly 5 because prices had gone up so much. That's when the masses come in. They go, oh, wow, prices went up so much. I want that. And they go in too late. So the smart money gets out. And so he sold all his California holdings and he bought in Texas the same year where they hadn't had any kind of boom. And that was because so much job growth and population growth was headed there, but home prices, like I said, they're a slow moving vehicle. So they hadn't caught up and it took years. But you could see he sold at the peak, cashed in all that equity, went and bought in Texas where it was cheap. Cash flowed really high because jobs were increasing, but home prices were low, and so you could make a bunch of money. And then look, it took a while, but finally those prices took off in Texas. So if you time it well, you can really, not all markets behave the same. So if you kind of get out of a bad market, get into a good one at the same time, you can avoid catastrophe. And so that's just something to pay attention to. You have time. If you have a property or an investment that has gone up a lot in value, this could be a really good time to get out of it because it takes a while for people to kind of catch on. And then you could go into markets where it's, you could sell one property in California and buy 10 somewhere else and spread it out. And then if you have a vacancy, you're not going to feel it as much if you have 10 properties versus one.
Hey, Kathy, I know you mentioned that you've got an interview coming up in a little over 1 minute. And so I wanted to make sure that we let you know that we'll definitely invite you back, and we'd love to hear more of this. And thank you very much for coming in and sharing. Oh,
you're so welcome. I'm really sorry for the difficulty getting in, but now I know how to do it, so we're set for next time.
Yep.
Awesome. Okay. Well, yeah, and then if you just it sounds like people will have access to the rest of that. And you know what? When I come back, I'll have more data, and that will be helpful because right now we're just sort of in the earthquake stage.
Yep, sounds excellent. We will we'll post this recording and the slides on our internal REI Club website, and I'll pass along Kathy's contact information as well. Thank you, everybody.
Thank you.
Thanks.
Thank you.
Thank you.
Thanks, everyone.
Yeah.
Bye.